We start on time, it's 11 o'clock. And we have today the topic, are alternative investments such as private markets and hedge funds on the rise again? My name is Thomas Breitenmoser. I'm leading up the consulting and controlling business at Complementa with a focus on institutional clients, mainly pension funds. And what was the topic chosen for today? We have seen in the past years, as a traditional investor in the markets in Switzerland, you had stellar returns. A typical institutional investor the last 5 years could have seen an annualized return of about 6.5% return. Where it's coming from, we had equity returns the last 5 years about north of 13%. Even bonds were up 3-4% annualized, and the real estate part of the portfolio was about north of 5% annualized. So there was all achievable without having alternative investments. But maybe the time has changed significantly, not only geopolitical, we also have seeing inflation in there. So alternatives and less correlated returns might be very interesting also looking forward. To discuss those kind of topics, I have 3 gentlemen, which all represent distinct part of the alternatives part, and I'd like to introduce them swiftly. Next to me, there is Benjamin Böhner. Benjamin Böhner works at Bellevue Asset Management, where he represents private markets, mainly in kind of venture cap area investments there, but you will, of course, have the time to introduce yourself more clearly. Then next to him is Frédéric Sonney. Frédéric Sonney is heading up the hedge fund business of Banque, Cantonale, Vaudoise. He looks mainly at hedge fund-of-fund programs in nowadays a more liquid area and also on risk premium investments. So that's part of him. And then last but not least, there's Philippe Naegeli. Philippe Naegeli is CEO of GenTwo. GenTwo is a provider of securitization, also in a really interesting and very niche market as watches or wine, but also private equity. And of course, he also wants to introduce him more detailed. So with that in mind, and I would like to start off, maybe to give each of you a brief introduction. What's your area, and especially which is the area you see at the most interesting times to invest in? Please, Benjamin.
Thank you. Yes, at Bellevue Private Markets, we focus on equity investments. Actually, we kind of stop where we start where venture stops. So that's kind of where we get engaged. So our companies, small and medium-sized enterprises, focusing on the DACH region, they will be mostly profitable already when we invest, and they are at the stage where they want to make the next bold movement in terms of company growth, be that to expand across border, or be that to build a new production line, to introduce a new product segment, other things that require heavy capital investment, that require probably a bit more guts than the bank that would lend would like to see. Most of the time you draw a bit into the red zone in terms of profitability because of heavy initial investment, but also this is at a stage where you already have good visibility when the returns are going to be coming back. So the majority of that technological risk that you'd have when you invest in a company at the grassroots or during the startup phase is mostly behind us when we invest. So it's a very interesting segment. You also don't need so much leverage as you do in a typical buyout type of transaction later on in a company's life cycle, and you can get to similar returns. That's been our strategy for a very long while. We've been doing that for 15 years with an investor group, and since about a year and a half, we're doing this together with the investor group also on a fund basis, always focusing on the DACH region. That's pretty much our business in terms of private markets.
Thank you very much. Frédéric?
Yeah, so I'm representing a far more liquid asset class, if I can call it like this, I would say, because what we do at BCV is basically hedge funds, so with monthly or quarterly liquidity. So we manage a fund of hedge funds, which for the last, I would say, 15 years, we haven't seen any interest, any significant subscription, but we are starting to see a couple of investors asking questions and being a bit more interested in this once again, let's call it asset class. It's a hedge funds as a portfolio, as an industry, is a low risk investment strategy with low volatilities of, let's say, 4, 5, 6%, and therefore low expected returns. But given, as Thomas said, given the situation, given the environment, and the expectation of very low returns on traditional asset classes like equities and even worse for bonds probably, people start to, it seems, be a bit interested in hedge funds and coming back to hedge funds.
Thank you. Philippe, if you can.
Yeah, thank you very much. Well, at GenTwo, our mission is to expand the investment universe. We help actually, or we are a solution infrastructure provider for many financial intermediaries in Switzerland, over 200 in Switzerland, actually, that we help to build bridges, actually securities, tokens, ETPs into all sorts of assets and asset classes. That starts with, of course, liquid portfolios that everybody knows in form of AMCs and so on, but then also on private equity, private debt, and then collectibles, exotics, and then also digital assets. So basically everything or all assets will be bankable with us, and that's what we do.
Okay, thank you. Now, a big headline right now is, of course, inflation and rising interests. Many people or journalists or in the industry thinks that the Fed, ECB is a little bit behind the curve at the moment. How does that imply your current investments? Benjamin.
Shall I try for an answer? I think alternatives are not very different to other asset classes when it comes to that. We'll all have to deal with that. I mean, the main impact of rising interest rates, or better said, even more important, of rising expectations of future interest rates is that it increases the discount factor. So basically, it decreases the net present value of future expected earnings. So what does that mean for us? We basically kind of tuning down what we expect to receive from a company in the future, or more importantly, if you assume that the rates will stay that high, it probably will have an impact on price earnings multiples, as you talk about it in the liquid space. We call it more EBITDA multiples, but it's a similar thing, similar concept. So we'll just assume that probably our exit multiples might not be quite as high as what we might have to pay now in order to invest in a company in the first place. So it means that we'll be a bit more conservative on our underwriting, factor that in, that there might be a inflationary environment for a more protracted period. But other than that, really, we don't expect for the private equity world particularly for this to be such a bad environment, because historically, if you look at the correlations between rising inflation and returns on liquid equity markets, same applies then for private equity, that's actually been quite good. So real assets as equities tend to perform well when you've got certain rates of inflation. It gets hairy when inflation gets completely out of control, but I think we're far away from that type of scenario for the time being.
Probably applies to most asset classes.
Correct.
It goes out of control.
Correct.
That's why this is so problematic.
Yes.
So what's your expected correlation to liquid equity markets in such kind of environment? Is that tendency increasing or decreasing?
I mean, over a certain period of time, if that inflation rise happens on a more measured scale, private equity can keep up better, because you'll have that pricing on of futures expectations much more heavily and faster in the liquid markets. If that goes over a certain period of time, I think it'll probably be pretty much in line with that. So you'll earn the illiquidity premium that you'll earn anyways. Then you might earn some additional alpha depending on whether you go with a manager that manages to create alpha or not. But there shouldn't be any difference from a theoretical perspective, because the drivers, after all, are what? Economic growth and then some idiosyncratic growth that comes from good companies and their stories. So I think we're pretty much in the same boat with markets overall.
So what you have is just a little bit of lagging factor just because we have less pricing regularity, and therefore maybe can help a little bit to smooth out in a portfolio context.
Correct.
But on the trend, it will be more or less very the same, with just less volatility.
I would think with one advantage for investors, of course, investors that go through a fund structure, a private equity fund will not make a bullet investment. It will always have an investment period, be it 3 years, 4 years, 5 years, depends on the strategy, during which period the manager invests in the best companies that they can identify. And at the same time, they have a harvesting period of another 4, 5, 6, 7 years where they divest again whenever the moment is right, when they can maximize value in those company holdings. So you're averaging in and you're averaging out, and that smoothens the effect that you might have in public markets and overreactions in terms of risk appetite or risk aversion quite a bit.
Okay, thank you. Now, Frédéric, how do you handle that with completely different means and different opportunities?
Yeah, the good thing with the hedge funds is that it's a very heterogeneous universe. So you have long-short equity funds, for instance, which invest long and short in equities, but typically keep some directional exposure. So they are, we say, net long exposed to the market. So when the market goes up, these hedge funds go up. When the market goes down, these hedge funds go down. So you have traditional equity beta. So even in hedge funds, you have this. And we've been saying for quite some time, I would say 2 or 3 years ago, that markets were, equity markets among others, were richly valued. We were a bit early, given the performance of equities over the last couple of years, but we started already to decrease our beta, our exposure to this systematic traditional equity beta, and increase the allocation to hedge funds that we believe can profit from market drawdowns, from bear markets, from the rise in interest rates. And this is precisely what is happening these days and for the couple of months. And yeah, talking about rates for 1.5 years, since summer 2020, rates are rising, and you have hedge fund strategies that profit from rising rates. And this year, so far, global macro managers and very simple trend-following strategies have profited quite a lot of rising rates. Performances of these two strategies are double-digit since the beginning of the year. So hedge funds have the opportunity to profit from markets which or an environment in which you cannot earn, let's call it, decent returns from traditional markets by being long-only equities, which are a priori richly valued, by being long-only rates, by being long-only perhaps even real estate. So hedge funds are in a situation where volatility is higher, correlations are lower. Everything is here for hedge funds to perform well with the activity of central banks as well, going back to some normalization. Macro managers can profit from this type of environments. So the outlook for hedge funds, I would say, in this environment is pretty good.
Okay, I just have the HFRI index in front of me, so just
which is down here today.
I mean, it always sounds great with hedge funds, and then
but it
was a lot of disappointment in the past, so that we are really on the rise again. That's what we're talking about here. And if I see, this is at the end of March, because we don't have that on a daily basis here. We have monthly basis. So with that, you said on down market you can benefit, etc. So if I have all the different hedge funds, you said the macro is good. It's really good. It was up 6%, 6.5%. But the equity hedge is down 5%. Diversified is down 2%. Distressed restructuring is just more or less up 0.0. Equity market neutral is down 1%. Event-driven is down 1.5%. Merger arb is up 1%. And then we have the weighted composite is down 0.8%. And that's in a way where Russia already invaded Ukraine. We have zero weights in Russia equities. We have almost no weights in the bonds there, and markets are down. Interest rate go up. We have a tremendous increase, and yet besides the macro you explained to me, I don't see actually a better portfolio than before. So in theory, it sounds perfect. When will you start deliver your industry? So it's a very tough question.
No, not that much. I would say the industry as a whole will not deliver. In a bear market, in a bear equity market, the industry as a whole will be negative. The return on hedge funds as a whole will be negative, and precisely because of equity long short, because of event-driven strategies, which all have some exposure, some positive exposure to equity markets, basically, or to the economy in general, if you like. Global macro managers are up 6% in 3 months.
Yep.
They are up this month as of today with the estimations we have. But if you have even more granularity, trend following strategies, which is something we are probably going to discuss about very liquid alternatives and hedge fund replications and things like this. Trend following strategies, which are very easy to replicate, which are very easy to implement, are up double digit. And mostly because of rising rates. They profited a lot from that. And also for those who are invested in commodities, from being long the vast majority of commodities. So sure, the industry is down, but mostly because of equity beta. So I think when you look at hedge funds, you shouldn't look at the industry as a whole because it's far too much heterogeneous. And as a whole, on average, it has equity beta, it has duration, it has credit risk, it has all the traditional sources of risk, which makes replication easier, by the way. But the industry as a whole is not it's not what is interesting in hedge funds, I think. You have in the hedge fund universe, you have strategies which are designed to benefit in such types of environments. And it's not long-short equity, it's not even driven probably, except for merger arb that you mentioned, which can be profitable in these types of environments, or not, but they can.
So the key takeaway is not buying the index or someone who is diversified in there. You have a manager which has distinct opinion on some strategies. So that's probably the key takeaway if I listen to you correctly.
Yeah, I would. If you invest directly in hedge funds, if you are big enough to do that, I would be more granular, more specific, choose specific buckets of the hedge fund industry. If you invest, if you are too small to have a team to manage your hedge fund portfolio, and you invest in hedge fund of funds, then you have basically, you don't have that many fund of hedge funds anymore because they've disappeared all over the years. But you have basically two main types of funds of funds. You have balanced fund of funds, which represent more or less the overall average industry. And you have, and I would say the majority of the funds of funds are funds which are strongly biased towards long-short equity strategies. And this is the bulk of the funds of the hedge funds you have, at least in Switzerland, because they've understood that you have higher returns when you invest in long-short equity than when you invest in relative value strategies, because relative value strategies, once again, it's low-digit volatility, and therefore low to mid-single-digit return, because there is no free lunch.
It sounds not too bad to me this year, low single-digit, by the way. So
the relative value?
No, whatever strategy which is positive, low single-digit. Yeah, no, it's okay. I have to bring.
But just something about relative value. When you look at these indices, they are a bit misleading as well because HFRI, for instance, in the relative value bucket, they put long-short credit funds, which have a lot of credit risk in them. So, and it biased the returns toward, the negative, unpleasant numbers.
Okay, thank you, Frédéric. So I have to bring along Philippe here. It's a little bit tough for you, the question on inflation, but maybe you can talk a little bit, how can you bring, in that case, uncorrelated return, but most of the time I think many agree that inflation is not so good for your portfolio. So what kind of thinking do you have here?
Yeah, I think I can quickly, at that I'm at the end of the table, summarize what they said, and I certainly would agree with that. It's about decorrelated asset class, it's about diversification, and that's also what we see, and we see a growing field of financial intermediaries, asset managers that are really caring about that. I mean, there are wonderful, I think, sectors to invest in, and with that, I think also that diversification shall grow and bring more uncorrelated assets to market with that. And finally, what always works in a time like this is ownership. And yes, when it completely escalates, of course, that would be bad. But finally, ownership matters. And I think oftentimes, and that's a bit now our view in contrary to the traditional banking view, we think of that color basically, of that diversification, and with that we also see that ownership as the most important, and that ownership of assets and that ownership in the engagement with these assets, so to say, brings also a lot of opportunities for decorrelation, and actually brings another fantasy and maybe a romantic fantasy back to market, that you also are in love with the things that you invest in and that you really care about them, and maybe also hold through these periods.
Thank you.
Maybe if I can
please
add to that quickly. Ownership is a very good tag word, really, if you think about that, because what happens when inflation is protracted and accelerates, and that's when it starts tipping for equities, is that companies shy away from making investment decisions and spending on capex because they're fearing that might not yield what it should yield. In a growth strategy, like we're promoting it and many other people out there are as well, by definition, you're investing because you want to invest. So you're investing in companies that are brave enough to make the next step, even in a scenario where inflation is rising. And that might eventually be the factor that distinguishes the returns that can be had from these types of companies from the overall market, which does have a beta to where global growth is going. And Absolutely. You can actually impact that through the individual company decisions. Might not mean that every decision will make you more return, but one of the main reasons why equities start trailing off in an inflationary environment is the fact that they're not investing enough. They're shying away from these decisions. And that you can influence with ownership. And
that's with ownership, you're a board member whatsoever, you can really see that the spending is enough up there. So therefore you should, on the longer term, get an extra return. So that's exactly. So it's one of the key performance indicators when investing to make sure that those growth plans are being realized. Yeah. Okay. So we have another obstacle here. There's a lot of headwinds at the moment. We have, of course, Russia doing war in the Ukraine. We have of that extremely high commodity price, which is great of commodity hedge funds, of course, it is there. So our return is up to 30%. But for most companies and for most investments, it's clearly not beneficial. It's a headwind, not a tailwind. Then further to that, we still have out of the COVID time, however we managed that globally, we still have some difficulties in supply chain. Most notably in chip manufacturing, which we see car production is still clearly below capacity just because they don't get enough chips at the moment. And we have again in China, Shanghai, we have all those news that 20 million are more or less in a lockdown. Now we hear that Beijing people are looking for food because they are fearing that they're very soon in the same situation. So how does that supply chain problematic, which we have here somewhere, in higher energy price, part of inflation in there, but I just want to relate more on the supply chain problematic there. What does that mean for your asset class, and how can you cope with that, or how can that be less detrimental than the traditional assets that I have in there? I hope they have rephrased that correctly. If you want to start with that, Benjamin, please.
Grand, yeah, thanks. Well, I guess on one hand, it's not so much a matter of the asset class itself. It's more a matter of the sectors that you are exposed to, and there are certain traditional sectors where the exposure is very high. You also mentioned tech and the chip industry. If you're sourcing a lot from Asia, it's an issue at the moment, not necessarily just because of the lockdowns, but also because of the delays in the ports and the shipping. Freight rates have gone up tremendously. Nordic bulk dry index, for example, has gone up very much, and that can have impacts. And it depends also on the industry in terms of how much of that price increase can be forwarded to the final customer. There are obviously certain industries where the price isn't so sensitive because simply the goods are needed. There's others where you talk more about discretionary spending, where the consumers might say, well, I'll just not spend on that, or might trade down. So that's a bit of an impact. And then really what matters most, I think, is a good company management. I can give you an example of a company in the e-commerce field that we have in our portfolio. And last year, when it looked like there's going to be another lockdown coming, they have taken the decision in January to order all the goods that they thought they would be needing for the Christmas season. And so they've basically had stuff in their warehouse, increasing the net working capital, which you'd normally say it's not very efficient, but it saved their business because they could deliver every single item that was ordered in their shop. If you haven't done that, if you had relied on the traditional model of just-in-time delivery and all that stuff, you'd probably run into a big issue. So I think that's something that the world will need to deal with. It's actually facing the fact that there will have to be more warehousing again. You have to have buffer stocks. You have to have alternative B and C for your suppliers. It's a matter of that stuff. It can be dealt with, and I guess terms like nearshoring or even reshoring might come back into the equation. You don't need to produce everything in Asia. And
a little bit deglobalization on a tiny scale.
Yeah, I wouldn't want to use that very aggressive word, put it that way, but yes, in certain matters. And if you
mentioned it, nearshoring. So
yeah,
basically.
Fair enough. And if you put ESG into the equation on top of it, right? Yep. Then I mean, there's so much going back and forth across the ocean, around the globe, which you might be able to produce here. And if you put the cost, the environmental cost of all that traffic into the full cost calculation, then actually it's almost a no-brainer to nearshore some of the things.
It has a lot to do how we deal with ESG, which is an extremely volatile expression itself. Correct. Maybe Philippe, you want to add on this topic?
Yeah, I think it's clearly understandable that a lot of these topics are coming back. I mean, we see that it already started with the political era, actually, with the Trump era, that these topics came back back in fashion, and now we see the effects of some escalations that actually all are not helping basically the globalization. And certainly also to be said, it will also not help inflation. It will certainly be the monster of that, and I think we only see the beginning of that. So yes, these topics are certainly well addressed. I think nearshoring is a topic, and I think it's also not an aggressive word to use deglobalization, because I think we should all think about how we want to produce and how we want to diversify and how we want to do things in the future with all the things that are happening right now and all the economic, so to say, developments that we see. So back to that, I think we only see the beginning of inflation, and now I don't know if that's appropriate, but my father once told me, you're not a little bit pregnant, and it's a bit the same with inflation. So that's just how I see.
Have you told that to Madame Lagarde?
No, but I think that oftentimes when I listen to the news, when I read, I must say that often gets forgotten, and we often think that we are in control of everything, and that's maybe not always the case. Mm-hmm. That would be my statement.
Okay. Now, Frédéric, you have this full range of opportunities in that area, which are given your asset class, and you have to deal with it. So how have you positioned on
I wish you didn't ask me this question. No, because it doesn't directly impact the hedge fund industry, I would say. It obviously indirectly impacts hedge funds through the value of their investments. And by the way, you forgot to mention the real estate crisis in China, which is one more. So of course, hedge funds are exposed to the Chinese economy. They are exposed to the technology sector. So of course, it has an impact on the performances that you mentioned for long-short equity, which are deeply down at around -5 year to date, and even worse at the end of April. But beyond that, no, I don't see any direct impact of this on the industry.
Okay. Good to hear. I'll talk to you in a year. Maybe another topic, maybe also back on the hedge funds. You just talked a bit, you have more liquid strategies. Hedge funds was clearly always quite illiquid. And you have 3 months, basically sometimes 6 months notice period or even longer. Now you're suddenly down to more liquid to 2 weeks, etc. Why is that beneficial and why won't that backfire?
About illiquidity depends on what you mean by illiquidity. So, for example, our fund of hedge funds has monthly liquidity with 45 days notice. So you can exit your investment quite quickly, I would say. There are other more liquid vehicles, and I think you make reference to the Replication fund, but in between you have a whole bunch of UCITS vehicles, which have been launched massively over the past decade, I would say, which have up to daily liquidity. So it's typically weekly, sometimes monthly, and for some of them daily liquidity. And I've absolutely no figures, no serious test, empirical analysis or anything, but my feeling is that UCITS funds, which are more liquid, and funds in which investors can get in and out very quickly on a daily or weekly basis, which are supposed to replicate the flagship funds of a given hedge fund. Typically, these UCITS vehicles seem to perform a little bit worse than the flagship funds. So in most cases, it's because there are more constraints. You have the 40-10-5 rules. You have, in terms of diversification of UCITS vehicles, you have rules that make your portfolio more diversified than the flagship fund is. But you also have in the industry hedge funds, which are perfectly replicated with a UCITS vehicle, and the performance tends to be lower. And this is very probably
and what does it make to correlation?
Is
correlation also higher to traditional, or is that the same as
No,
performance cost?
Just underperformance. It looks like, once again, it's just intuition, just feeling, nothing serious empirically. But the feeling is that it's the liquidity provided to investors, which has a cost in terms of mostly transaction costs, which makes the performance of UCITS a little bit worse, not as good as the flagship fund. And you can go all the way down to the liquidity spectrum with the hedge fund replication fund that you mentioned. Here the idea is to replicate the performance of hedge funds without investing in hedge funds. So the idea is to look at the performance of the hedge fund industry, the performance of the different asset classes, main asset classes, and to infer from what you see what are the positions of hedge funds in these different asset classes. So given the performances of hedge funds, given the performance of equities, bonds, FX, and so on, you infer what would be the exposures of hedge funds to these different asset classes, and you take these positions. So this is basically how it works. And it works surprisingly well, I would say. I was the first surprise, I have to acknowledge. But and the reason is that on average, as I said before, on average, the hedge fund industry has equity beta, has duration, has credit risk, is exposed to given currencies, is exposed to given commodities. And this is something that you can replicate pretty easily.
Is replication also cheaper? One of the criticisms
It is
in
cheaper,
the industry, anyway, in the alternative industry, is that relatively high price beta in the market you get extremely cheap. And you had traditionally also with a performance fee, which then is questionable of what is measured against, where is the risk, who is the bearer of the risk, and who has to pay for that. Is this replication strategy also a little bit cheaper and therefore also might be working a little bit better? Or is that thinking of mine completely the wrong direction?
It is definitely cheaper because it's not that difficult to do. And this is precisely the idea of launching a hedge fund replication fund, is to increase liquidity and to decrease fees, and if you like, to increase transparency, even though I'm not sure what it really means. But yes, sure, it's definitely cheaper, yes. And about hedge fund fees, which I know you want to discuss about that? No, you don't? Yes, it's expensive.
I'm just telling I mean, you just tell the very beginning, are they on the
I
rise
felt
again?
like
you were not in demand for the
question.
last years. There were several reasons. There are several reasons on the horizon why it could come in demand again, but probably one angle is that it should not be as expensive on the first look there, and for the investor who bears the risk, they like to pay performance fee, but on the right measurement. So that's a little bit the question of what's behind there. But maybe I'll come back to Benjamin. Another,
I was assuming you were to come with that one.
Because one of the criticism on private equity is the same thing. Private equity is great investments, and you really have capex in there, and you have a lot of skill set. And I'm sure you at Bellevue have that as one of many of your competitors as well. And you can really bring great performance out there. But on the other hand, most of the time, it's a very beneficial for the GP, but usually not for the LP. Say it like that in a private equity term. So, what was the fee development lately? How do you see it going forward? Or can you comment a little bit on that one? Because again,
sure.
I could just compare to general equity.
Sure, I can.
3 basis points, up 13%.
Fair enough. I guess first answer to that, up 13% equities. What you have seen very robust over the last 5, 10, 15% distinct horizons, 15-year distinct horizons, you had private equity as an index. I use Preqin as an example because it's the broadest database you can find on private equity funds, with an outperformance of, on average, 500 to 750 basis points per annum. So 5 to 7.5% above whatever equities have done is the average private equity performance if you take distressed out and also fund of funds. But that is a net performance figure. That's important.
Net performance.
Exactly.
So there's definitely something there which
Correct.
gives the liquidity premium to the investor.
I would think so. And another important, I think, concept is, and that distinguishes a bit the fee model in private equity world from, for example, hedge fund world. On the hedge fund side, private equity is charged, on the hedge fund side, performance fee is charged on the NAV basis. Whenever you have a higher NAV, you can take out that fee, right? But it doesn't mean crystallization of the profits at the level of the investor. In the private equity space, the manager only charges performance fee, called carried interest, once an asset is sold. The money is returned back to the investor, and it only starts ticking once the initial capital investment and all the costs that were built up throughout the fund's life till that stage have also been returned to the investor. So it's carry charged on actual delivered net return. And that makes the whole subject a little bit easier to deal with. It also means that if you have
clearer line.
Exactly, and if you have a loss in the next investment, it means you can't charge carry till you recovered that again. So in a way, it's fair. There's an alignment of interest in there, which is not necessarily always the case in the hedge fund space, because if the investor decides to sell after 5 years, and he's in a loss at that stage, the manager will still have taken performance fee out of his investment. And that does change, I think, the perspective a bit. And this is why we don't have the discussion on why do you charge performance fee. We have a discussion on why do you charge as much performance fee as you charge. And there is a few venture firms out there that charge what they call super carry, and that's 30% of the profit. I mean, that's really becomes extreme, especially in some cases where the manager only has 1 or 2% skin in the game. We're at the opposite side of that curve. For example, we have almost 20% skin in the game in our current fund, so that's a whole lot of money put in by the individuals in the firm, and we're charging on a floating scale. So for the first couple of percent, there is no performance fee. Between 5 and 10, it's 5, and so it goes up. And that has come down a lot. But to answer your initial question, how has it developed in the industry, I've just received the latest Preqin report in terms of fund terms that explains the fund terms of all the funds that were launched throughout 2021. The average is still 2% management fee, and 19.5% carry. So it's actually the 220 model. It's still alive and kicking in the industry.
I see.
Yeah.
At least it delivers performance, but it's still rich for the investors to pay for. But the clear alignment is there. So the time is clicking, and of course we have 3 completely distinct different persons here in the alternative. The only commonality is that they really can get a little bit less correlated return and interesting return to your portfolios. But before finish off and everyone giving a short opportunity to make us a final statement, maybe I want to open up for questions, if there might be any.
Go ahead.
I have a question for Philippe.
Yeah,
Your business model seems to me a B2B business model.
it is.
It is. And if you then compare your service to traditional banks or Swiss quotes or such things, what do you add on
Yeah.
in your service versus those?
Yeah. What we basically do is we give all of our clients an own white label setup for issuing their securities. So we set up an own structure for them, a company framework, much like you would see that in a nutshell, like with a fund administrator that you would look for, and they would set up the fund for you, they would do the calculation and such, provide the services for that, and install the directors and so on. That's what we do for the securitization business. And we help then to set up the structure and basically put up these products for you out of your own segregated structure. So it's segregation of this issuance process in full.
And in the assets you do that, you go further than traditional investment.
We go all along, but there is no asset, so to say, which is...
Watches?
Yeah.
Yeah.
Yeah, we did portfolio of watches, we did wine. We did
And the latest one was
Forest.
virtual. Maybe you can...
Yeah, the latest one was real estate in the metaverse. So if you want to flee the crisis, you can
Which you
also
already
move.
said, real estate in meta, how it can say real in meta,
Yeah,
but
exactly.
anyway, that's another
Yeah,
topic.
real estate in the metaverse, a portfolio of that. So if you want to move to the metaverse and hide from all the conflicts out there and the delivery chains, you just go there. That's what some of our clients do.
Any other final remark?
Well, yeah, I think when we look at the world, it's really colorful, and I would encourage everybody in the audience to actually look at that color. Not exactly what we are doing, but what is happening in the market. And with all of these asset classes, there are fantastic, wonderful stories that are not only interesting but also emotional. And I think with that we have beautiful things to discover going forward. I mean, only one example. I think it's wonderful to have the crypto valley here in Switzerland. It's wonderful to have 2 banks established out of that crypto valley. And even if you have nothing to do with that, it's just beautiful that Switzerland is the place that things like that happen, and you can go and see them and actually walk to their front door. They're not in the metaverse yet. and touch them and get involved in that experience. And I think that's what I would encourage everybody to do, to be more open about their investment side. And maybe sometimes with that, you can also forget that 0.5% down, 0.5% up.
Yeah. I would have a comment on that, but Frédéric?
Yeah, just a word on performance of hedge funds.
Yes,
because
please,
We've insisted a lot on that and a lot on the short term, which is absolutely not the way we should look at hedge fund performance. I think we have to have a look at a longer term, with a longer term perspective, and this is how I see hedge funds. Hedge funds, you can expect from them a risk premium of, let's say, 3%, 2 to 4% in excess of cash. And that's what they have delivered prior to the global financial crisis. And that's, surprisingly, what they have delivered after the global financial crisis. So if you look at hedge fund performance since 2010, it's around 3% excess premium in excess of cash. The only difference between before the crisis and after is that before you had interest rates at 5 on average. After the crisis, you had interest rates at 0, which means that the performance of hedge funds went from 5 plus 3, 8 to 3. Okay, so but this is what you should expect from hedge funds. It's around, my estimate, around 3% risk premium over the long term.
And we see that
Not in
bonds
the
are
3
down at
first
the
months
moment,
of,
minus 4%. It seems very interesting. Benjamin, final remarks.
Yeah, I think I'd like to address two common, let's say, reservations about private equity in general. One you have mentioned already, which is the fee load, and I hope to have brought across that this is really not as much as an issue because we're talking about fees that still allow high net returns. The other two factors, I think, are people will say it's illiquid. And yes, absolutely, it's illiquid, and nobody should ever say it's not, because it simply is illiquid. But if you look at a portfolio in overall, you should always have a strategic asset allocation. I mean, you're in pension consulting know that very well, that the majority of returns is explained by a good asset allocation over time, right? It's not so much trading in and out. Timing is something that a lot of people don't get right, and it needs a lot of luck as well. So it's a strategic asset allocation decision. And when you make a strategic decision to invest X% in equity, why not take a certain portion of equity and substitute it with private equity? Economically driven, it's the same thing, and you're holding it for a longer period of time anyway. Why don't just have a strategic allocation to private equity as your equity allocation? You could do the same thing on the rates, not so much on the rates, but on the credit risk side, you could do the same thing and get some more private debt in there and just have it as the strategic portion of your portfolio, knowing right and well that these aren't assets you can move around very quickly, and funding them over time. If you build up a private equity portfolio over 4 or 5 years, instead of one decision in 1 year, you've got better diversification across vintages, so start years, and it starts funding itself. By the time you allocate to your 5th fund in 5 years down the road, probably the first distributions of the first fund will fund that, so it becomes a self-funding vehicle, and then it even alleviates you a bit from that liquidity constraint that you have in order to fund the capital calls. So I think it's a matter of constructing the portfolio right, then it's not so difficult to have a space for private equity in the portfolio, and with companies like GenTwo who are offering solutions for feeder funds and similar things, you can also get the minimum sizes down, even for funds that only take 10 million tickets. It's well possible to invest in private equity these days. I think that would be my final words on the asset class.
Very good. Thank you very much. We come to the conclusion. My personal opinion, yes, private markets and hedge funds will arise again. So I think that's just the positive comment at the end. Thank you very much.